Their stock market crashed. The stock market will crash just like it did in 1929. When the election, you would have had a very bad period. I think a lot of the stock market going down was because of a really bad 4 years that we had.
Is it time to sell? While mainstream media paints a grim picture, the reality is far more complex. The stock market is experiencing significant turmoil, and many are asking whether it's time to sell before things get worse. Donald Trump's actions are at the center of this chaos. Why the sudden dip? What does it mean? And how do you turn this around in your favor? Let's get to the answers. The current panic in the stock market is palpable. Fear spreads quickly, especially when headlines scream disaster. It's easy to feel overwhelmed. Everyone is asking if they should sell. But let's pause for a moment. Panic rarely leads to good decisions. Instead, we must understand the roots of this fear. Investors are reacting to uncertainty. Uncertainty breeds doubt. When the stock market fluctuates wildly, people start to question their investments. They fear losing their hard-earned money. This fear can drive even the most seasoned investors to make rash decisions. But what causes this uncertainty? It often ties back to external factors.
Under the Trump administration, you will pay a tariff, and in some cases, a rather large one. Other countries have used tariffs against us for decades, and now it's our turn to start using them against those other countries.
Right now, all eyes are on one figure, Donald Trump. His actions have far-reaching consequences. What looks like a single step can start a chain reaction, affecting the entire world's financial health. Trade war. Let's delve into the first major trigger behind the current turmoil: Trump's trade war. This is where we can start to see the connections between policy and market behavior. Trump has positioned himself as a tough negotiator, fighting for American jobs and interests. However, the tariffs he has imposed could lead to increased costs for consumers and businesses alike. In February 2025, Trump announced tariffs on Canadian energy imports and increased tariffs on other goods. Canada responded with its own tariffs, creating a cycle of retaliation.
To agree with the Wall Street Journal. But Donald, they point out that even though you're a very smart guy, this is a very dumb thing to do.
This not only disrupts trade, but also drives up prices for everyday items, hitting consumers directly in their wallets. As business owners, we can attest that higher costs often get passed down to consumers. This results in increased prices for cars, appliances, and food, stretching household budgets even further.
And China makes the fentanyl. China makes the fentanyl, gives it to Mexico, puts it through Canada, puts it through different places, mostly Mexico, but also a lot through Canada. And so all three haven't treated us very well.
Moreover, countries like China are forming new trade alliances, reducing their dependence on the U.S. This isolationist approach could have long-term repercussions for the American economy. While Trump may not desire high tariffs as a permanent solution, he seems to use them as a negotiation tactic. The uncertainty stemming from his unpredictable tariff policies is what truly rattles the stock market. Investors thrive on stability, and this constant back and forth creates a volatile environment. Let's take a step back to the 1930s. The Smoot-Hawley Tariff Act aimed to protect American jobs. It imposed heavy tariffs on imports. Initially, it appeared to benefit U.S. businesses. But soon, other countries retaliated with their own tariffs. Trade ground to a halt. The economy spiraled into the Great Depression.
Any chances that you will ban on the tariffs on aluminum and the ones that are planned for April 2nd?
No.
You are not going to change your mind?
Y tenemos plan A, plan B, plan C para lo que decida el gobierno de los Estados Unidos. Ahora es muy importante que sepa el pueblo de México que siempre vamos a defender la dignidad de nuestro pueblo.
Canadians are reasonable and we are polite, but we will not back down from a fight. Not when our country and the well-being of everyone in it is at stake.
Are you expecting a recession this year?
I hate to predict things like that. There is a period of transition because what we're doing is very big. we're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time. But I think it should be great for us.
This historical lesson is vital. It shows the potential consequences of protectionist policies. Fast forward to today, and we see similar patterns emerging. Trump's tariffs may provide short-term gains for some industries. However, the long-term effects could be detrimental. Higher prices and weakened global trade ties threaten economic stability. Yet, despite the looming challenges, there's a silver lining. If approached wisely, this situation can create opportunities for savvy investors. Understanding the historical context of tariffs allows us to make informed decisions. We can prepare for the fallout and position ourselves strategically. Trump's views on NATO have raised eyebrows. He questions the very foundation of this military alliance. He argues that the U.S. should not protect its allies unless they pay their fair share. While this may seem fair on the surface, the implications are far-reaching. If the U.S. reduces its commitment to NATO, it could lead to instability. Countries like Russia and China may see this as an opportunity. They could exploit the situation, leading to increased tensions and potential conflicts. This uncertainty makes markets jittery. When investors sense instability, they react swiftly. A weakened NATO could embolden aggressive actions from adversaries. It could lead to a new arms race or even military conflicts. Such scenarios would wreak havoc on global markets. The uncertainty surrounding NATO has a tangible impact. Investors dislike unpredictability. When the security of nations is at stake, markets often panic. This panic can lead to sell-offs, affecting stock prices across the board. Higher military spending becomes a likely outcome. Countries may feel compelled to bolster their defenses. This shift diverts funds from other sectors, slowing economic growth. In turn, this creates a ripple effect, impacting businesses and consumers alike. Energy prices could also spike. Conflicts or tensions in Europe can disrupt supply chains. When energy costs rise, it affects everything from transportation to manufacturing. The end result is higher prices for consumers, further straining household budgets. If you have enjoyed this video so far, please give it a thumbs up and subscribe to our YouTube channel for additional great content. Finally, there's a theory gaining traction that Trump may be intentionally crashing the stock market. This might sound far-fetched, but consider this. Trump has consistently criticized high interest rates, which he sees as detrimental to economic growth. By creating a climate of fear and uncertainty, he may be aiming to force the Federal Reserve to lower interest rates. The Federal Reserve operates independently, but its decisions are influenced by economic conditions. If a recession appears imminent, the Fed may feel compelled to cut interest rates to stimulate growth. For Trump, lower interest rates mean reduced costs for government debt, which currently stands at an astronomical $36.5 trillion. Imagine having a massive credit card bill with high interest rates. Lowering those rates would save a significant amount annually, allowing for more funds to be directed towards paying down the principal. If Trump can orchestrate this scenario, it could be seen as a clever economic strategy. So, why do lower interest rates matter? They can make borrowing cheaper. This is crucial for businesses and consumers alike. When rates are low, spending can increase. People buy homes, cars, and invest in their futures. It's a boost for the economy. But when rates are high, everything slows down. People hold back on spending. Businesses hesitate to invest. This can lead to a slowdown in growth, and that's not good news for anyone. It's a delicate dance, and right now it feels like we're stepping on toes. Lowering interest rates could spark a recovery. It could encourage spending and investment. But getting to that point is tricky. It requires careful planning and timing. The market is watching closely, and everyone is hoping for a sign of stability. Market drops can be triggered by economic news, geopolitical tensions, or even unexpected events. For instance, if inflation rises, people start worrying. They fear higher interest rates, which can slow down spending and investment. Then there are external factors like trade wars or natural disasters. All of these can shake investor confidence. When people start to panic, selling pressure builds and prices drop even further. So, when you see a decline, take a step back. Look at the bigger picture. Is this a temporary blip, or is there something more significant going on? Understanding the context can help you make better decisions. It's important to know that not all market drops are created equal. There are different types, and each has its implications. First up is a market correction. This is when the market drops by at least 10%. It happens regularly and is often seen as a healthy part of the market cycle. Then we have bear markets. These are more serious, defined by a drop of 20% or more. They're less common, but can be painful. Bear markets usually last longer and can take a toll on investor sentiment. Lastly, there's a market collapse. This is rare but can be devastating. A collapse means prices drop by 40% or more. It's a scary situation, and it can take years for the market to recover. When you're faced with a market drop, it's crucial to stay level-headed. Don't let fear dictate your actions. Instead, focus on your long-term goals. History shows that markets do recover. Staying invested, especially during tough times, can pay off in the long run. Consider dollar cost averaging. This means investing a fixed amount regularly, regardless of market conditions. It can help you buy more shares when prices are low and fewer when they're high. Over time, this strategy can smooth out your investment costs. How to benefit from the market crash. So, how can you navigate these turbulent waters? It's essential to remember that stock market crashes are a normal part of investing. History shows us that every downturn has been followed by recovery. The key is to remain calm and make strategic moves. Step 1. Invest while the market is down. Before diving into investments, ensure you have a solid financial foundation. This means building an emergency fund and eliminating high-interest debt. If you've done that, consider this. Stocks are essentially on sale during a market downturn. For instance, during the 2008 financial crisis, we continued to invest at the bottom and saw my investments double in a few years. Many people panic and sell during downturns, locking in their losses. Instead, consistent investing during low periods allows you to buy assets at discounted prices. Step 2. Stay disciplined and think long-term. Market crashes follow predictable cycles. Corrections, 10 to 20% drops, bear markets, 20 to 40% drops, and full-blown collapses, over 40% drops. The worst thing you can do is let emotions dictate your decisions. Instead of panic selling, consider increasing your investments while prices are low. Adopt a long-term strategy like dollar cost averaging, where you invest a fixed amount regularly, regardless of market conditions. This approach minimizes the risk of buying at the wrong time and helps build wealth steadily over time. Step 3. Diversify your investments. Diversification is crucial in weathering market downturns. Spread your investments across various asset types: stocks, bonds, precious metals, real estate, and even cryptocurrencies. Consider including dividend-paying stocks, which can provide passive income even during downturns. Market crashes are not the end of the world. They are opportunities for those who understand how to navigate them. Instead of fearing the market, prepare, invest wisely, and stay patient. Those who make smart moves now will be the ones to benefit when the market rebounds. Building wealth amidst market fluctuations. Let's talk about building wealth even when the market feels shaky. It's all about perspective. Yes, the market can be unpredictable, but that doesn't mean you should stop investing altogether. In fact, this could be the perfect time to get in. When prices drop, opportunities arise. You can pick up quality investments at a discount. Think about it. When you see a sale at your favorite store, do you hesitate? No, you grab the good stuff while it's cheap. The same principle applies to investing. However, it's essential to do your homework. Don't just jump in blindly. Look for solid companies with good fundamentals. These are the ones that are likely to weather the storm and bounce back when the market stabilizes. Financial discipline is crucial. It's what separates successful investors from those who panic and sell at the wrong time. Staying disciplined means sticking to your plan, even when emotions run high. During market drops, it's tempting to react. You might want to sell everything and sit on the sidelines, but that's usually a mistake. Instead, focus on your strategy, keep investing, and remember your long-term goals. Developing good financial habits is essential. This means budgeting, saving, and investing regularly. These practices will serve you well no matter what the market is doing. As we wrap things up, it's clear that the market is unpredictable. But that doesn't mean you should panic. Understanding market dynamics, protecting your data, and staying disciplined are all key to navigating these turbulent times. Investing is a long-term game. Stay focused on your goals and don't let short-term fluctuations derail your plans. The market will recover, and those who stay the course will reap the rewards. In the end, it's all about being informed and prepared. Keep learning, stay disciplined. Your financial future depends on it. If you are concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link to learn more. If you enjoyed this video, please give it a thumbs up and subscribe to our YouTube channel for more great content.